Low-grade ore, low-grade drill results, low-grade sample results. Are they still low-grade? Hi, George Sanders, President, Goldcliff Resource Corporation. It is Friday afternoon, October 17th, 2025, and I want to share with shareholders and our YouTube community some discussions we've been having this week internally with our technical team, our board of directors, discussions I've been having with brokers and with other technical people in the business and other junior mining executives. And we've been talking about metal prices. Now, you wouldn't have been tuned in here and interested in following us if you weren't keenly interested already in what gold and silver prices are doing and have been doing. That's not really what we want to share with you. We want to share with you discussions about the impact of those prices on grade. Again, something that sounds very obvious, but I do believe and will share with you how the industry hasn't quite figured out what the new impact is. And when we start thinking about that, it's pretty exciting for the future. But before I do that, I'd just like to set the scene for some of the thoughts that we want to share with a few statistics, and I wrote these down so I don't fudge them or get them incorrect. So this afternoon, the price of gold closed at $4,250.80 in US dollars. For those of us doing business in Canada, $5,963 is the Canadian dollar gold price. Silver closed at $51.86 or $72.78 Canadian. That makes 1 gram of gold in United States dollars worth $135.58, and in Canadian dollars $190 Canadian for a gram. A gram of silver is $1.68 US and $2.32 Canadian. Okay, those are numbers that we can all look up. Some of you are following them actively. What's the point here? So many of us in the business have been looking for projects, evaluating the projects of others, promoting and driving forward our own projects with a mindset of what constitutes low grade, what constitutes mid grade, and what constitutes high grade. And of course, all of those things at the end of the day are situation specific, and they're dependent on many factors, strip ratios, the depth of mineralization, metallurgy, permitting, all of those kinds of things. So we can't just reduce the idea to the metal price times the grade. But really, when we're evaluating a prospect or when we're thinking about driving it forward, we have to have in the back of our minds, does this asset have potential value? And it seems to me, and this has been my discussion this week, and most people have agreed, that many of us in the business still have a view of what constitutes particularly low grade and mid grade from pricing levels back as low as $500 gold, back as low as $1,000 or $1,500. I'll give you a real example of that. In evaluating a property recently, there were some old samples and some old drill holes at 0.3 grams. Well, that's another way of saying the host rock is leverite. Leave her right there because there's no value. At best, in an open pit scenario with a low strip ratio, 0.3 grams is marginal. But is it? At today's values, 0.3 grams in the United States is $40 rock. In Canada, it's $57 rock. We recorded about a month and a bit ago a video from our Panorama Ridge project. And you know, all of the activity that we did on that project was in a sub $1,000 an ounce environment. And in that project, there are a number of exciting drill intercepts over 1 gram, some over 2 grams, but many, many more in that 0.3 to 0.5 gram range. And we just said to ourselves at the time, this is really good, but it's too marginal. It just won't make it. The reason we've been doing work and talking about Panorama Ridge this summer and early fall is because the metal prices have warranted a relook at that asset. That is going on across the junior resource space. It's going on across the mining space, and it's real. And I can tell you that those of us that have been in the business for so many years still have, we know what the prices are, we know how to do the multiplication, but we still think of 0.3 grams as almost cut off or waste or highly marginal, when in fact it could be, at today's metal prices in the right situation, highly profitable. We're seeing this leverage with operations, with operating mining companies. And the huge leverage to these metal prices and their impact on grade is not so much with the really good operations. What's happening there is those are going from good to great. And the companies with those operations, like Agnico Eagle, are being rewarded, and they're trading at all-time highs with record free cash flow. But the real leverage comes from producers that were losing money 6 months ago. And they've gone from, frankly, marginal, terrible operations to now not just slightly profitable, but pretty strong free cash flow. And that leverage is showing up not just in the junior producers who have those assets, but it's showing up now in the exploration space for companies like Goldcliff, who are reevaluating older low-grade assets. And I'll give another example, or trying to advance mid-grade assets. So our new epithermal project at Kettle Valley, our best surface sample was 2.62 grams gold and 181 grams silver. We were very excited about that. We've crowed about it. We've talked about it. We've promoted it. We are very enthusiastic about it. But honestly, we looked at that as mid-grade. If there was enough of it right on surface that it could be open pit, it would be a very strong grade open pit. But for underground, kind of mid-grade. Well, really? When we just looked at the other day, the Canadian dollar value of that sample, it's just under $900 to the ton. Now, we're not making any economic projections here. What we're saying is that what we previously thought of as low grade or as mid grade has to be reevaluated in the light of the current metal price environment. And the other place, of course, where you get this tremendous leverage is with high grade material. At Ainsworth, the #1 mine, which is the model for our activity in that historic silver district, and the model for our direct shipping approach to exploration of that historic camp. That little operation mined 40,000 tons and produced just a tad under 2 million ounces. Well, at today's Canadian dollar value, that's $145 million of revenue that came out of 40,000 tons. We think that is a highly exciting possibility to find another one of those pods or lenses in the Ainsworth camp, hence our activity there and all of the discussions that we've had and videos we've produced about Ainsworth, and there are more to come. But just to sum up, many of you who are new to this space are sort of thinking, what's this guy talking about? This is so obvious. But I really do have to make the point that many of us in the industry who are looking at grades in and around a gram, a little bit below to maybe up to 2 grams, had this mindset of what the value of that rock is. And the reality is the value of that material is 3 or 4 times what we have in our mindset. And that's really exciting. That creates great opportunities for those of us in the exploration space. Stay tuned. We'll have more videos in the very near future.